We are live in Abuja, and in just a moment, the CBN monetary policy will be kicking off the last for the year. The central bank has actually retained monetary policy rates at 11.5%, with the asymmetric corridors at plus 100. And basis, when you look at the points, the CBN governor, Godwin Emefiele, on Tuesday, said after the policy meeting began on Monday. So a lot is expected, and is riding on this to chart the way for the rest of the year, and more importantly, a little projection into what the new year actually holds for Nigeria, and looking at the numbers in terms of inflation and how Nigerians can actually position themselves in the spending and the buying, literally going into the Utah boards. Let's listen to the governor.
And members of the press, you are welcome to Central Bank of Nigeria. The Monetary Policy Committee met on the 22nd and 23rd of November 2021 in light of continued recovery of the global economy and improving output growth in the domestic economy. Though the growth outlook for the global economy for the rest of the year and into 2022 remains favorable, the uneven pace of recovery across countries has persisted. This was driven primarily by COVID-19 vaccination rate, size of policy support, and regional economic conditions. On the domestic front, the continued support by the monetary and fiscal authorities is sustaining the growth recovery in Nigeria, notwithstanding the persistence of security challenges and legacy infrastructural constraints. The committee appraised the developments in the global economy, international financial environments, and the domestic economy, as well as the outlook for the rest of the year and the first quarter of 2022. 10 members of the committee attended this meeting. The global economic development. Global output growth has remained upbeat as economic agents defy the continued threat posed by the sharp rise in infection rates associated with the Delta strain of COVID-19 virus. The IMF, on its part, in its October 2021 World Economic Outlook, downgraded, albeit marginally, its growth forecast for advanced economies in 2021. The downgrade was, however, offset by an upgrade of the growth forecast for the emerging markets and developing economies in 2021. Despite the forecast for a robust recovery of the global economy in 2021, the uneven pace of vaccination across the globe and the continued rise in infection rates by the more fatal and mutating strains of the COVID-19 virus suggest that the current two-speed recovery of the global economy may persist longer than anticipated. This may, however, be remedied if governments across the globe rally to improve coordination in the distribution of vaccines to aid the early attainment of global herd immunity. The committee noted that the downside risks to the recovery may persist if the spread of this new variant is not addressed urgently. In light of the above dynamics and associated headwinds, the IMF downgraded its 2021 growth forecast for the global economy from 6% to 5.9%. It also revised the projection for the advanced economies downwards from 5.6% to 5.2%, while the forecast for the emerging markets and developing economies was revised upwards to 6.4% from 6.3%. Inflation across several advanced economies is expected to continue its upward trend in 2022, contrary to earlier expectations of transiency, as commodity prices continue to recover and feeding into energy and good prices. This is on the backdrop of rising demand associated with a sustained rebound in global output growth amid lingering supply constraints. In response to the persistence of price developments, the U.S. Fed commenced tapering its monthly bond buying program. Other advanced economy central banks have also indicated the likelihood to follow suit in the short to medium term. In key emerging market and developing economies, inflation remained relatively high compared with advanced economies. This is mostly due to supply-side constraints associated with the pandemic, exchange rate pressures, and other legacy structural problems. The severity of inflationary pressures in this group of economies, however, varies across countries in relation to the specific structure and dynamics of the individual economies. In the global financial markets, equity prices largely remained a strong post-lockdown recovery, while investors continued to maintain a sizable hedge in gold, possibly to ease the impact of a rebound of the pandemic as infection rates continue to rise. The financial markets remain undoubtedly bullish, suggesting that investors are cautious of the rebound in infection rates and rising inflation in major economies. Price of gold and other precious metals have remained significantly above their post-pandemic levels, an indication that investors have not fully returned to the financial markets. Domestic developments. According to the National Bureau of Statistics, NBS, the real gross domestic product (GDP) grew by 4.03% year-on-year in the third quarter of 2021, compared with 5.01% and minus 3.62% in second quarter of 2021 and Q3 of 2020 respectively. The growth trajectory post-lockdown has thus been positive in the last 4 quarters following the exit from the recession in 2020. Quarter-on-quarter, real GDP grew by 11.07% during the third quarter of 2021, compared with minus 0.79% in the preceding quarter. This improvement in real GDP was driven by growth in both the oil and non-oil sectors by 12.05% and 10.99% respectively. The committee also noted the continued improvement in the Manufacturing Purchasing Managers Index, which, though remained below the 50 index points benchmark, rose to 47.3 index points in October 2021 from 46.6 index points in September 2021. This improvement indicated a gradual recovery of output growth, driven largely by the increase in new orders associated with rising aggregate demand and upswing in business activities. The non-manufacturing PMIs, however, declined to 47.5 index points in October 2021 from 47.8 index points in September 2021 as uncertainties persisted around the poor security situation. Committee noted the continued moderation in headline inflation year-on-year to 15.99% in October 2021 from 16.63% in the previous month, the 6th consecutive month of decline. The decrease was attributed to a marginal decline in both the food and core components to 18.34% and 13.34% in October 2021 from 19.57% and 13.74% respectively in September 2021. Inflation, however, remained above the bank's implicit tolerance corridor of 6 to 9% and above its benchmark policy rate of 11.5% despite its progressive decline. Observing developments in the monetary aggregates, the committee noted that broad money supply M3 grew by 7.1% in October 2021 compared with 4.72% in September 2021. This was driven by growth in the non-net domestic assets NDA by 9.12% in October 2021 compared with 10.71% recorded in September 2021. Net foreign assets NFA, on the other hand, contracted moderately by minus 1.5% in October 2021 compared with minus 20.85% in the preceding month. The continued growth in non-net domestic assets was largely driven by increased claims on the federal government and other public non-financial corporations, private sector, and state and local governments. In the financial markets, money market rates oscillated within the standing deposit facilities corridor, reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average open buyback (OBB) rate increased to 12.18% in October 2021 from 11.11% in September 2021, while the monthly weighted average interbank call rate decreased from 13.21% in September 2021 to 10.10% in October 2021. The increase in the open buyback rate reflected the tight liquidity condition in the banking system. MPC noted the positive performance of the equities market in the review period, with the all-share index and market capitalization increasing to 43,199.27 and 22.55 trillion on November 19, 2021, from 39,219.61 and 20.43 trillion on August 31, 2021. This depicts improved investor sentiment following impressive corporate earnings of listed corporations on the exchange. These led to a new bargain hunting drive by investors. The MPC noted that the capital adequacy ratio and liquidity ratios both remained above their prudential limits of 15.2 and 41.2% respectively. The non-performing loans ratio at 5.29% in October 2021 reflects progressive improvement compared with 5.7% in October 2021. The committee, however, urged the bank to sustain its tight prudential regime to bring the non-performing loans ratio below 5% prudential benchmark. The gross external reserves stood at $41.4 billion as at November 18, 2021, compared with $41.34 billion in October 2021, a moderate increase of 0.17%. Our outlook. The overall outlook for both the global and domestic economies remain upbeat, but the significant domestic downside risks clouding the path to full recovery. The key risks remain the unabating COVID-19 pandemic and uneven progress in vaccination. As the US Fed commences scaling down of its monthly bond buying program, there is increased likelihood that other advanced economy central banks will follow in the same direction. With this impending development, external financial conditions will likely tighten for most of the emerging markets and developing economies in view of huge capital flow reversals to the advanced economies as yields rise. This will no doubt deepen the growth divergence between these two groups of economies. Forecasts for key macroeconomic variables for Nigerian economy indicate continuing rebound in growth recovery for the rest of the year. This is expected on the back of continued support by both the monetary and fiscal policy, sustained high crude oil prices, and most importantly, availability of COVID-19 vaccines, as well as high turnover for vaccination in Nigeria. Accordingly, the Nigerian economy is forecast to grow in 2021 by 3.1% CBN estimate, 3% by federal government estimate, and 2.6% by the IMF estimate. Inflation is expected to continue its downward trajectory as the harvest season sets in and the government works on improving the security situation to ease the bottlenecks constraining food supply. The committee's consideration. The committee commended the continued recovery in output growth following a positive outcome in the third quarter of 2021. Based on the current outlook for price development and growth, members carefully reviewed the options confronting the committee in the short to medium term, taking into consideration key downside risks to growth and upside risks to inflation. Members reiterated the need to remain cautious and urged both the monetary and fiscal authorities to sustain their support for the recovery as the pandemic was yet to be over. Committee, however, noted that with the sustained intervention by the CBN, economic activities will normalize in the short to medium term, leading to improved output growth and lowering of inflationary pressure. The MPC also urged the fiscal authorities to sustain the current efforts to revamp the economy through continued support to the critical sectors of our economy. The continued security challenges across the country remained a major source of concern for members, noting its impact on business confidence, foreign investor inflows, and overall economic activities. The persistence of insecurity in major food producing areas remained a key downside risk to our recovery. Committee called on security agencies in the country to increase their presence in order to boost public confidence and facilitate the movement of people, goods, and services across the country. With improved security, especially in these food-producing areas, members expressed optimism that food inflation will drop significantly following successful harvest and distribution. Committee also commended the gradual diversification of the economy with the increased contribution of the non-oil sector to government revenues and called for more support to increase non-oil exports as a source of foreign exchange into the economy. Members reiterated the impact of poor infrastructure on rising domestic price levels, urging the federal government to prioritize investment in public utilities to improve the business environment. These include transportation network, power supply, education, and health. Following the President's recent international call to investors to channel investments to Nigeria, members were of the view that funding of such projects could be sourced through equitable partnerships with foreign investors and Nigerians in diaspora. Committee noted that the equities market remained in a strong position, signposting continued investor confidence in the Nigerian economy. Members thus urged the monetary and fiscal authorities to build on this sustained confidence to attract more foreign direct investments into Nigeria. MPC welcomed the continued resilience of the banking system in the face of severe shocks to both the domestic and global economies, commending the bank's management for maintaining overall stability in the banking system. Committee thus called on the bank to continue to push for increased intermediation as the way forward to reduce unemployment, create wealth, enhance production, and improve aggregate demand to strengthen its recovery. On this note, members applauded the success achieved by the bank's various intervention schemes, which have contributed to both the demand and supply sides of the economy. Committee reviewed the performance of the bank's various interventions aimed at sustaining recovery of output growth and addressing the downside risk to other external and domestic shocks to the economy. Interventions continued largely in the manufacturing as well as industries, agriculture, energy and infrastructure, healthcare, and micro, small, and medium enterprises. Under the targeted credit facility, the bank has disbursed a total of 363.49 billion naira to 766,719 beneficiaries, comprising 638,070 households, 128,649 small businesses. Under its Agribusiness Small and Medium Enterprise Investment Scheme, AXMIS, the bank has released 134.63 billion to 37,571 entrepreneurs. Between September and October 2021, under the Anchor Borrowers Program, the bank disbursed 43.19 billion to support the cultivation of over 250,000 hectares of maize, sorghum, soya beans, and rice during the 2021 dry season, and 5.88 billion to finance 6 large-scale agricultural projects under the Commercial Agricultural Credit Scheme (CACS). Cumulatively, the bank has disbursed a total of 864 billion to 4.1 million farmers, cultivating 5.01 million hectares of land. The bank also disbursed a sum of 41.2 billion for the commencement of the Brown Revolution, a large-scale wheat program to wean Nigeria off imports by 35% during the first year alone. In addition, the bank disbursed a sum of 261.92 billion for 42 additional projects under the 1 trillion naira manufacturing intervention. Cumulatively, the bank has disbursed a sum of 1.08 trillion under this scheme. As part of its effort to support the resilience of the health sector, the bank disbursed 5.39 billion to 9 healthcare projects under the healthcare sector's intervention facility just within September and October 2021. The bank has also cumulatively disbursed the sum of 108.65 billion to hospitals and pharmaceutical industry. 54 of the 117 projects funded are for hospital services. Committee was gratified that the funding under the health sector has resulted in the establishment of 2 new cancer centers in Nigeria, over 59 MRI and more than 42 CT scan centers all over the country within a space of 18 months. To further promote entrepreneurship development among Nigerian youths, the bank recently approved the implementation of the Tertiary Institutions Entrepreneurship Scheme. The scheme is designed to create a paradigm shift among undergraduates and graduates of tertiary institutions in Nigeria from white-collar jobs towards entrepreneurship development. The guidelines for the implementation of the scheme was recently published, as Bank of Industry is presently partnering the bank for the pilot implementation phase. Under the National Mass Metering Program, 8.69 billion naira was disbursed to 4 distribution companies under the scheme's phase 0. The sum of 47.66 billion has been disbursed so far for the acquisition of 858,026 electricity meters. Also, in furtherance of its intervention in the energy sector, the bank released 27.03 billion to power sector players under the Nigerian Bulk Electricity Trading Payment Assurance Facility Program. This is in addition to the 37.69 billion disbursed to 8 distribution companies recently under the Nigerian Electricity Market Stabilization Facility. The bank has also disbursed the sum of 39.2 billion naira under the Nigerian Gas Expansion Program to promote the migration to produce compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuels in Nigeria. Furthermore, the bank recently introduced the 100 for 100 policy on production and productivity (PPP), designed to create a flow of finance and investments to enterprises with potential to kick-start a sustainable economic growth trajectory, accelerate structural transformation, promote diversification, and improve productivity in the country. It is geared to support private sector companies with the aim of reducing certain imports, increasing non-oil exports, and improving the FX generating capacity of the economy. The bank will select and finance 100 of such companies at 100-day intervals in line with detailed selection criteria as contained in its guidelines, and roll this over for another 100 companies for the next 100 days. The Targeted Credit Facility TCF was particularly highlighted by the committee for its contribution to alleviating poverty at the grassroots in Nigeria. Committee thus urged the bank to continue its support through the Targeted Credit Facility to ensure that more people benefit from this program. With the commencement of monetary policy normalization by the US Fed and impending interest rates lift-off by central banks in some advanced economies, the MPC called on the federal government to intensify its drive towards a counter-cyclical fiscal policy in view of the imminent tightening and external financial conditions. Committee members therefore noted with concern that the gradual normalization of monetary policy by this group of economies will dampen the recovery of several emerging market and developing economies in the short to medium term due to the sharp reversal of capital flows. Committee also evaluated the development in China relating to the reoccurring pandemic, power outages, and crisis in the property market, noting the likely impact of this could have on Nigeria as a major trading partner. Members thus called on the bank to ensure that necessary buffers are put in place to shield the economy from downside risks associated with this development. In general, members expressed confidence in the ongoing policies of both the monetary and fiscal authorities, which in their view was the hallmark of the current recovery and restoration of macroeconomic stability in Nigeria. They therefore called on both the authorities to look beyond the current position and plan towards attracting sustainable investment flows into Nigeria. The committee's decision. At this meeting, MPC was gratified that its policy actions in the past had started to yield positive results, given the remarkable improvement in gross domestic product, which stood at 4.03% during the third quarter of 2021, and the sixth consecutive month moderation in inflation to 15.99% in October 2021. Given the level of its conviction about the efficacy of its actions on macroeconomic variables, MPC felt that whereas tightening would further help to rein in inflation aggressively, it nevertheless feels that tightening will increase the cost of funds and constrain output growth. On the other hand, whereas loosening will lower policy rates, ease liquidity pressures, and stimulate additional credit creation, which will boost output growth, MPC also thinks that loosening will further widen the negative real interest rate gap and compound the price distortions in the money market, which could fuel inflationary pressures. As whether to hold its existing stance, MPC believes that the existing monetary policy stance has supported the growth recovery and should be allowed to continue for a little longer for consolidation to achieve the MPC's mandate of price stability that is conducive to growth. The committee also feels that a hold stance will enable it carefully appraise the implications of unfolding global development around policy tapering and normalization by the advanced economies. Based on the foregoing, committee decided on a whole to hold all policy parameters constant to support the enabling environment for sustained recovery of the Nigerian economy. Committee therefore decided by unanimous vote to retain the monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain the MPR by 11.5%, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5% and retain liquidity ratio at 30%. I thank you most sincerely for your attention.